What's up, everyone? It's Caddy with MoneyVest. In today's video, we are going to be talking about Salesforce, ticker symbol CRM. I'm going to be going over everything related to their recent first quarter fiscal year 25 earnings. They dropped over 20% for the first time in over 20 years. And of course, selling off quite aggressively. They are down from their all-time highs. So you got lots to discuss and lots to go over in this video for this company. I'll go over some of the more important intrinsic values for CRM, as well as technical support and resistance levels. The stock is down over 27%, with the market cap now sitting at just over $220 billion. As always, if you enjoy this video and find it helpful, make sure that you drop a like and of course subscribe to the channel if you're just joining us for the first time. And links to our Discord and Patreon is going to be down below if you're interested in joining us. And more importantly, getting early access to our MoneyVest Pro platform. We're doing an internal beta launch in the first week of July for all the existing members. So everyone who's part of the community will have access to this amazing software and this platform where you can access over 7,000 US publicly traded companies and look at their entire fundamental analysis, meaning key statistics related to their growth rates, their valuations, their efficiency, financial health and margins, profitability. And you can also visualize a lot of this data while plotting this on a chart. So you can, like, for example, right now I'm looking at 7 years worth of revenues for Apple on an annual basis. I can also plot gross profit, I can operating income, I can also look at total revenue and net income. And I've actually made this spreadsheet, made this sort of table in a very, very easy to read manner. So I've kind of included some thicker lines broken down by years where you can see how well Apple has been growing their revenues, profitability, things like that, things of that nature. And you can also look at some other things such as the balance sheet. You can also include total cash. Let's include total assets. Let's also include long-term debt. And now you've got much more dynamic, much better looking, visual representation of Apple's fundamentals. And also let's just include free cash flow while we're at it. And boom, there we go. We've also got free cash flow now for Apple as well. And then of course we've got analyst estimates over here. Then you can also take a look at our calculators, so analyzer, and analyze for intrinsic value for whatever stock you're analyzing. And MoneyVest metrics is going to be some of the metrics that I look at for individual stocks, broken down by 3, 5, 7, and 10 years. And it's going to show you what's the M score, which is the MoneyVest score out of 5, and the check mark showing us whether it's a growth, slow growth, high growth, is it good, bad, worsening, improving, compressing. There's specific remarks to each and every single metric that you can access as well. And I'm going to be adding more functionality and more stuff over time on this platform as well. So there's right now a 51% discount. This pricing is going to be locked for you forever. Trust me on this. I've got bigger plans and a lot of amazing things to launch and offer in terms of functionality and tools that's going to be available for all of you. So link's going to be down below. We'd love to have you on board as well, with a 16% additional annual discount also available. So first things first, let's talk a little bit about CRM. So Salesforce drops over 20% for its worst day in 2004, and a lot of that happened on the back of weaker than expected first fiscal quarter guidance from the company. Analysts said broader macroeconomic challenges returned with a vengeance during Salesforce's first quarter, and despite the miss, many analysts are optimistic about how the company could benefit from its use of generative artificial intelligence as well. Now, I dug deep looking at the company's numbers, looking at the revenue, the actual profitability, the margins, and everything. Straight up overreaction is all I can say from Salesforce, down about 20% on Thursday, marking its stock's worst day in nearly 20 years. Its worst trading day on record is July 21st, 2004, when the shares fell 27%, and just days after the company went public. And here we are 20 years later in June of this was May of 2024, the stock down 20%, and also because of weaker than expected guidance. And the cloud software vendor said revenue for the period increased 11% to just over $9 billion, which was shy of the $9.17 billion expected by analysts as well. And they expect second quarter adjusted earnings per share to $2.34 to $2.36 on $9.2 to $9.25 billion, while analysts were expecting $2.40 and revenue of just over $9.37 billion. So a little bit softer guidance, 20% decline, really, I think seems a little bit of an overdone move. And the price target was also lowered significantly from $323 down to $260 for the company as well. Now, this right here was the guidance, but before that, let's just talk a little bit about what really happened here. We're looking at revenues going up from 8.2 to 9.1 billion. We got gross profit going up from 6.1 to 6.9 billion dollars. We got total net income significantly going up. Of course, that was probably because the company had a pretty significant expense same time last year. And that's why income from operations was significantly lower because of the restructuring costs that Salesforce incurred back in 2023, $711 million there compared to only $8 million here. So that was obviously a big expense. And of course, gains and losses from strategic investments also taking a hit of about $141 million here for the company same time last year, with a gain of $37 million this year. So that, of course, all adding up to this number of $1.5 billion for the company. And income from provision of income taxes, also $1.8 billion compared to $326 million same time last year. So now, of course, shares outstanding at constant 980 million. Earnings per share, $1.56. So overall, I think the numbers were very good, growing on a year-over-year basis. Revenue, we got gross profit, we got operating income, and we got net income with a significant growth on a year-over-year basis. And this right here were the margins. So if you take a look at the total revenues, about, of course, 100%, majority of that coming from subscription and support, which is a SaaS model, which is exactly why their margins are so high. And total cost of revenue is only 24%. So their gross margins are 76%, a 2 percentage point expansion compared to the same time last year. And you got operating expenses, 57% compared to 69%. So income from operations also up to 19% margins. And their bottom line net income margins expanding up to 17% for the company as well. If you take a look at the balance sheet now, so cash and cash equivalents and marketable securities, these two numbers are now sitting at a little bit over 17, almost $18 billion for the company, with a total debt under current liabilities, $1 billion, and under total non-current debt sitting at $8.4 billion. So the company's got plenty of cash, twice as much cash compared to the debt on the balance sheet, and liabilities are $36 billion compared to total assets of $96 billion. However, I will mention that $49 billion of those total sort of assets are basically in goodwill. So $40.9 billion, almost $49 billion are in goodwill, which of course is a pretty significant chunk. We're talking over 50, almost 50% of their total assets are in goodwill, which, by the way, we've also got under MoneyVest metrics. If you come down, and again, we think of all these things, right? That's why it's all going to be in the MoneyVest metrics. If you come over to the efficiency table, what do you have here is return on assets, return on equity, return on invested capital, return on capital employed. Then we got CapEx as a percentage of revenue. We've got operating leverage, SBC, that's your stock-based compensation. Every company is going to have to pass through these checks in order for it to be investable. We've got stock-based compensation as a percentage of revenue, as a percentage of operating cash flow, as a percentage of free cash flow. And if you come over to financial table, now you're looking at solvency ratio, more importantly, inventory as a percentage of total assets, and goodwill as a percentage of total assets as well. In this case, of course, we've got Salesforce scoring a very high number at well over 50%. But we take into account these things because goodwill are intangible assets, right? So they're not something that you can touch or see. It's basically intangibles. And inventory also, we don't want a significant inventory buildup where we're not seeing sell-through rates. Apple obviously has a very low inventory as a percentage of total assets, under 2%. And that's been pretty much the average over the last 5-7 years. So that's, again, very, very solid. And they also don't have any goodwill on the balance sheet as well. So that's exactly what we want. We want cold, hard assets. And that's exactly what Apple has, is a lot of cash. That's why their net debt is negative almost $50 billion. So more cash than debt on the balance sheet, of course. And then, of course, we've also got current and quick ratio close to 1. But again, that's not about Apple. But the idea is that all of these metrics are going to be available on the MoneyVest platform. You can quickly do the analysis very, very fast. Now, coming over to the analyst expectations and their own guidance. So total revenue, 9.2 to 9.25 billion for the upcoming quarter. Overall, for the entire fiscal year 25, 37.7 to $38 billion. And they're expecting for non-GAAP diluted earnings per share between 986 and 994. Let's call it $10, right? Just to keep things simple, let's call it $10 per share for Salesforce. Right now, they're trading at about 233. So 233 divided by 10, we're looking at 23.3 times non-GAAP diluted forward earnings multiple. Quite reasonable. Quite actually reasonable. Quite low, I would even say. If you come over to the expectations, so earnings expectations are for $9.91, then $11, then $12.64, then $14.75. So that's, again, very solid. And again, coming back over to balance sheet, negative $4 billion, negative $5 billion of net debt. So significantly more cash compared to the debt levels on the balance sheet for CRM. Now I'll jump over to the intrinsic value. We're going to plug in CRM. So this again is going to be available on the MoneyVest platform. Right now we can't because we don't have the data for Salesforce right now. But let's just do CRM. And since they do have 972 million and we're looking at $10 in earnings per share in 2024, we're looking at a net income of just under $10 billion for the company. Last year they did net income of about $4 billion. This year, they can expect anywhere between $9.5, $9.7 billion of net income. That considering $40 billion, that's about a 25% margin on the bottom line for net income for the company on a non-GAAP basis, of course. So we're going to plug in 9.750 just to be on the safe side. Let's just do 9.7. And now we're going to grow the company, right? So $10 in earnings per share. And we're going to look at the forecast by 2027. They're expecting $14.75. Let's just call it $15. We're looking at a growth rate of just under 15%, right? Let's just go with 12% to be a little bit more conservative here. And we're going to apply a price earnings multiple of, let's just do 20. 20 times price earnings multiple, 12% discount rate, 10% margin of safety, share buyback. Let's just take a quick look. The company in the past has not been buying shares. They've just been a little bit more stable. So I'm going to keep that at 0%. And we're looking at about $180 a share in intrinsic value. Now, some people would argue, Caddy, that's way too low for price earnings multiple, because it's a SaaS company, very, very high margins. Let's just go with 25. And now we're looking at a stock that's almost trading at its intrinsic value of 225. So it's really between 20 and 25. I think growth rate, we can even go as much as 14%, but then I'll have to lower the P multiple to 20. Now we're sitting at just sub $200, right? So this is the sensitivity grid that you can check. And based on different price earnings multiple and based on different growth rates, we're now looking at sub $200 for Salesforce as an intrinsic value, which basically sits perfectly inside this green rectangle. And that's one of the reasons why I didn't really pick up Salesforce here at these levels, even after the drop, is because I think much better value for money is going to be in the 190s. Anything sub $200 would make for a very good deal for Salesforce. And again, you could even argue that 210 was not a bad price. You could at least start a position there, get a small starter going, and then of course dollar cost average more heavily when it's closer to 190s or $200. So that's going to be a much stronger area of support, previous resistance, also a support, and also aligned with our analysis of the intrinsic value for the company long term. So that's going to be the next sort of support. Very, very oversold right now with a huge resistance sitting up to 250 to as much as $287, $290. Huge gap to also fill for Salesforce, so keep that in mind. Hope you all enjoyed this video, found it helpful. Make sure you drop a like and don't forget to subscribe to the channel. And also, if you want to access all of our MoneyVest platform, including all of our members only videos, private content, trade alerts, trade ideas, everything, there is a 51% discount on this pricing. And that pricing is going to be locked for you forever. And link's going to be down below if you want to join. And there's an additional 16% annual discount that you can also take advantage of. As always, happy investing, and I'll see you all in the next video.